Let's talk about Forex. So what is Forex actually? Well, quite simply, the foreign exchange, also known as Forex, or the FX market, is a global marketplace for the exchange of national currencies against each other. Now, we can agree that currencies are very important to most people around the world, whether they realize it or not, because currencies need to be exchanged for various reasons like commerce and trade, and also for speculative reasons. If you live in the modern world, chances are that you engage in forex trading without even knowing it. If you have ever exchanged one currency for another currency, you have in that moment participated in forex trading. For instance, let's assume you live in a different country and you want to go to Egypt to see the pyramids. You will have to exchange your national currency into the Egyptian pound to enable you pay for that experience. If you live in the US and want to buy cheese from France, either you or the company you buy the cheese from has to pay the French for the cheese in euros. This means that the US importer would have to exchange the equivalent value of US dollars into euros in order to make that trade. A unique aspect of the foreign exchange market is that there is no central location or centralized exchange. Rather, currency trading is conducted electronically over the counter. This means that all transactions occur via computer networks between traders around the world. The foreign exchange market is open 24 hours a day and 5 days a week, only closing down during the weekends. Currencies are traded worldwide across almost every time zone and facilitated by the major financial centers, which include London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. The foreign exchange market is one of the most actively traded markets in the world, with an average daily trading volume of $5 trillion. Now, while a lot of foreign exchange takes place for practical purposes, the vast majority of currency trading is undertaken with the aim of making a profit. The amount of currency conversions on a daily basis can make price movements of some currencies extremely volatile. It is this volatility that makes Forex so attractive to traders and investors, bringing about a greater chance of higher profits while also increasing the risk. Forex trading is the simultaneous buying of one currency and selling another currency. Think of buying a currency as buying a share in a particular country, like buying shares in a company. The price of the currency is usually a direct reflection of the market's opinion on the current and future health of its respective economy. In forex trading, when you buy, say, the British pound, you are buying a share in the British economy. You are in essence taking a stand that the British economy is doing well at the moment and will even get better as time goes. Once you sell those shares back to the market at a higher exchange rate in the future, you will end up with a profit. Currency values are constantly fluctuating at different exchange rates. So what is an exchange rate, you might ask? Well, an exchange rate is simply the relative price of two currencies from two different countries. So in other words, an exchange rate tells you how much currency you can receive in exchange for another currency. It is the constant fluctuation of currency exchange rates that provides currency traders and investors with the opportunity to make profits when trading the foreign exchange market.